Good morning, everybody. Hey, welcome to Tuesday, March 22nd. Hope your day is going or your week is going well. Yesterday we had a little bit of a give back on the marketplace. The question is, where can we go today? Not much in the way of earnings report. We did have a couple come out that we'll talk about with Dave. On the economic front, not much happening there either as we kind of get ready to close out this quarter here in the next week and a half or so. So with that, just a reminder, there's only one thing that any of us can control, because we can't control what happens in over across to the Ukraine and Russia, and we sure as heck can't control what happens in Washington, D.C. But we can control how much risk we have in our current portfolio. Give us a call at 863-382-0037 to walk through our core retirement design, where we can help you design the retirement you always dreamed of. With that, we've got Dave coming up next.
Take it out there from the 80s. It's 8:38 now, 22 before 9. Let's check in on your money and see what's going on. One of my tip sheets was saying that slightly less bad is better than very bad. That's kind of the way it looks in the world these days, too. Let's see if it's improving on the markets this morning. Phillip Statler from Statler Financial Services is on the line. Phillip, good morning. How are you?
Hey, good morning, Dave. Doing well today. It is, the issue is that we're really getting down to the end of the quarter, and there's just not much happening. And in terms of earnings or even, the macro stuff is just, we're kind of in that waylay where we're just not much out there.
It really does. The middle 2 weeks of the month, especially when you're past the end of earnings season, really get boring. I mean, imagine what the middle 2 weeks of April are going to be like, and we won't have much. Well, we'll be in the middle of earnings, and then we'll be fine. But it's somewhat on the quiet side, and sometimes no news is good news. We were off a little bit yesterday on the markets. The Dow was off 202 points. S&P was off by, 2 points, and the NASDAQ was off by about 55. But across a week and a day, there's a little bit of buoyancy going on the indexes right now, and that's why I was kind of cackling about one of my tip sheets saying that it's only slightly less bad, but that's better than very bad, and that gives us a little bit of upward momentum,
That's true. And after yesterday's little bit of give back from last week's good week, so far we've got at least some green ink this morning.
Yeah, we'll take what we can get in the process, because really we're into that we don't know mode at this point. The Russians yesterday told the Ukrainians, surrender the city, with that southeastern city in Ukraine. Surrender, or we're going to keep on bombing. And Ukrainians told them to put it where the sun doesn't shine, so Russians started bombing again. That's basically a matter of things are as they were. It's tragic, it's disgusting, but it's happening. On Wall Street, as you say, we're right at the butt end of earnings season, so there's not a whole heck of a lot going on. Chairman Paulson from the Federal Reserve, my quote that I had was that the Federal Reserve will adjust policy as needed to lower inflation or avoid recession. But you read the larger part of the article, and it sounds like he's far more ready to take out a big club and raise the interest rates a lot more in the next few months, right?
That's what I gleaned from it, is that he's not so worried about a recession at this point. He's more worried about getting inflation under control.
And that's kind of job one at the moment. We're at full employment, and full employment plus comparatively as far as people that actually want to go back to work. And inflation is out of control, and right now we don't have a recession on the horizon. But you and I have been kind of waving red flags now for the last few weeks that the Fed is not exactly well reputed for remembering to turn off the spigot once they've got too much in the system, and turn the spigot back on after they've cut it off too much. So there's always that risk. And if the hawks on the Federal Reserve Open Market Committee keep beating the drum to be able to raise the interest rates, well, I keep hearkening back to the Russian central bank that just said, oh, what the heck, and they doubled their interest rate in one day when this whole kerfuffle started.
Oh, my. Yeah. As I read through it, one of the things that stuck out is that, we could start reducing our balance sheet as early as May.
Ooh, that is the other side of it. We talk about interest rates, but there was also some discussion, and it's one of the reasons that the minutes to the Open Market Committee are going to be so big. The other half of the tightening of the money supply is selling off some of those bonds and mortgages that the Federal Reserve has accumulated. I don't think most folks realize that probably the majority of our mortgages in the country right now actually they're owned by the Federal Reserve at this point because they've been buying mortgages and corporate bonds like they're going out of style.
Yeah, they are. I mean, to the tune of $9 trillion.
And that's a pretty healthy chunk of our gross national product, all being held in the name of our government central bank, which, kind of makes a few of us on the libertarian side of the fence go, whoa, wait a minute, that's not what we had in mind.
Exactly. So I'm not, I mean, I guess the Fed has the authority or they wouldn't have done it, but I'm not sure that was what they were designed to do.
It's a continuation. You got to keep in mind too. I mean, it's been now 14 years that we've been in some form of economic stimulus program, dating all the way back to the '09 recession. So we really never got out of that, and there never really was a time when they were doing things in order to prop the economy up during the Great Recession. There never really was a time to unwind things. So we're looking at like a 14, 15-year pattern here that somewhere down the line we got to unwind, but we've really dug ourselves into a big hole of stimulative economic policy on the Federal Reserve.
And that's right. We really have. And it's, you're right, it's 14 years worth. And it seems to me that as you look back over that 14 years, there were some years that we could have started to unwind some of this stuff, maybe not as fast, but it is what it is. And we're going to have to deal with it going forward, because it's going to be a big deal when we start trying to unwind this thing.
Yeah, absolutely. I mean, we had those growth years during the Trump times, the 4 years that Trump was in office. Yes, that would have been the time to do it. But if you were a Federal Reserve chairman, would you really want to put up the reaction from President Trump if you were the one to raise interest rates while he was saying he wanted to grow faster? I mean, politics gets in the way when the brains say we should actually be doing it. And now the brains say we got to be careful. And politics are going to get in the way of doing it that way. So this is not a job I don't think anybody should want. Would you?
No, I don't think so. I think it is, you can't win either way, right?
Absolutely not. Like I said, Trump would have roasted you on the coils of Twitter if you'd done something that was intellectually smart during his administration. And now Biden is sitting there saying, well, please don't do too terribly much because we sure don't want to crash the economy before the midterm elections or before the next presidential elections. Now the Democrats are saying the same thing Trump was saying 4 years ago.
Exactly. So we continue to bounce this ball down the road. And at some point, we're going to have to take our medicine, and, hopefully it won't be as bad as you and I think it might, but it is what it is. And we do have to start dealing with it at some point. And with inflation as high as it is, you don't really have much choice right now. They've got to start doing something.
I've been describing it as castor oil. It's something you know is good for you, but boy, it tastes rotten when you have to take it, right?
You're so right.
It's the tail end of earnings season. We were bemoaning the fact there's not a whole lot of news to talk about, and there isn't. But I noticed right at the top of my big winner list this morning in pre-market trading, Nike is up there. Now, I was saying yesterday that I kind of expected them to be one of those unique stocks that could actually be a market mover because they're supply chain dependent. They've got a trade center in China and the Middle and the Far East where they actually do a lot of business. Plus, they're a premium product here, so I thought they might actually be a bellwether. There must be some good news looking at the stocks change.
Well, they did. They beat pretty much across the board. Their earnings were 87 cents, was 16 cents above estimates. Revenue was well above expectations. They've been helped by their digital sales ability to really navigate through that and create more demand that way. They also have been able to successfully navigate through the supply chain issues that we've seen. And so that's helped them really put together a decent quarter. They're up almost 5% this morning.
Yeah, I was going to say it's right at the top of my big winner list, and kind of a lackadaisical start to the day today. When you talked about e-commerce sales and whatnot, we got to mention a tidbit that you found on the news ticker earlier too. Alibaba, the Asian equivalent of Amazon, I guess would be the best way to put it. They're continuing to fight the downward spiral in China, I gather.
Well, they did. And so they did not report earnings, but they did come out and make an announcement that they're going to increase their share buyback program to $25 billion, the largest ever for a China-based e-commerce company. And so that's got them up almost, a little over 9.5% this morning.
Which might actually have them off their 52-week low, right?
Yeah, it does. I mean, it's puts them at about $113 right now. So that's pretty good. You're right, because they have been suffering dramatically this last quarter.
Yeah, with the rumors out of the Chinese economy compressing a little bit, they haven't been exactly beneficiaries of any good news lately. So, other reports that we got this morning, I think we're pretty much out of household names, I'd bet.
Yeah, we are. We got one other earnings report, though, from Tencent Music. And they came out with better than expected quarterly earnings as well. And they're going to look at and start to pursue a secondary listing on the Hong Kong Stock Exchange. I found that kind of interesting. And so they're getting a nice little bump this morning. They're not a very expensive stock. I mean, they closed yesterday at $4.65. So they're up 6% this morning. So right now about $4.93. So well off their lows of $2.95, but way, way off their high of $32. So they got a long way to go to get back up there.
Whoa, yeah, the 10-to-1 difference between where they are and where the top was. Resetting the table for the morning, it was an off day, but a slight off day on Wall Street. 0.5% down on the Dow was the biggest loser in the bunch, which in the context of recent weeks is actually a flat day almost. 45 minutes before we open, what are we looking at this morning, Phillip?
So we have pretty much green ink across the board now, Dave. The NASDAQ's kind of bounced back and forth, but the NASDAQ 100 right now is up a little over 0.1%. Earlier, I did see it dip into the red slightly. The S&P 500 is up a little over 0.25%, and the Dow 30 is up about a little over 0.4%. So, but everything's in the green. On the commodity side, a lot of green ink there as well, except for silver. Silver is down about 0.5%. I'm going to say gold's really flat right now. It's less than 0.1% up. I will say, Dave, crude oil is heading the wrong direction, up 0.75% right now to almost $111 a barrel.
The thing that really scares me is by delayed quote has it about $1.50 lower than that. So it's on the way up and it's going up rapidly today.
It is. It really is. And I saw a couple of headlines that kind of gave some indication of it's going back up as well.
We kind of expected that, as much as we hate to admit it. Overseas markets, I got green ink across the board there too. Asian Rim was looking at us and saying, well, that's not a bad give back. Everybody was up at the close. European markets are also up. France is doing a big recovery. They're up almost 4% halfway through their day. Rest of the index is about 0.5% or so halfway through the day. Keeping tabs on one's retirement account at any age is important, but the strategy differs depending upon how old you are and how long you've got until retirement. How do I find you to get a customized plan to make sure I'm managing my risk properly, Phillip?
You're so right, Dave. That's why we developed our core retirement design to help people design the retirement they always dreamed of. Give us a call at 863-382-0037 to schedule your core retirement design appointment. And then catch us this weekend for the Statler Financial Radio Show, 6 a.m. and noon on Saturday, 10 a.m. Sunday morning on Highlands News Talk, 730 and 95.3 FM.
I do appreciate it. Back here again tomorrow morning together again. Phillip, you have a good day, and we'll see you tomorrow.
All right, man. You too.
Thank you. It's 105.7 Light FM and Statler Financial Services. Phillip Statler.
Hey, folks. Again, I want to thank you for joining us today. It hopefully will end up in the green, but you'll find out tomorrow when you join us again. Hey, until then, take care. Bye now.